Fed officials see upside risks to inflation, possibly leading to more rate hikes. Fed saw quote unquote significant inflation risks that may merit more hikes. With all that in mind, of thinking of inflation, China until the Netherlands and Germany until the whole oil situation, the whole presidential election, there's a lot of craziness in the market, which might reasonably lead you to believe that's why the market's selling, but it's not that. And if you thought it was because of the strange economic and monetary times, you're wrong. The real reason is you. You have no other option in this world to blame besides yourself. It's because of you degenerates watching this right now, YOLOing, slinging your zero DTEs. Goldman Sachs blames zero-day options for fueling S&P 500 sell-off. It is nothing else besides that. You are to blame. If you want to know who has the potential to have caused all of this, you better take a long, hard look in the mirror. Look closely at the contours of Tuesday's tumble in the S&P 500 and fingerprints of a new market force come into focus. I'm just picturing Goldman going around kind of like a sleuth, looking for that one fragment of a fingerprint that they can match together with other ones that they found at other financial crime scenes. Their options tied to the S&P 500 with a maturity less than 24 hours. A flurry of trading in the contracts known as 0 days till expiration was the backdrop to a jarring acceleration of the day's decline, one in which the equity benchmark slid roughly 0.4% in 20 minutes. Market makers, whose need to keep books balanced often means that they must buy or sell stock in mass when option traders cascade in, were forced into action by furious trading and bearish puts with a strike price of 4,440. Those options saw almost 100,000 contracts change hands during the session, or 45 billion in notional value, which we've recently learned is a silly way to look at the world of options. 45 billion. We're not talking about everyone exercising it. Most of this open interest ends up dying off before the actual expiration, as their cost spiked to $9 from 70 cents in a short span near the session's end. It sent market makers on the other side of the transaction in a dash for hedges to stay market neutral. In this case, that meant an exodus from equities. There's not enough liquidity on the screens to handle market makers' delta hedging, such as a dramatic move over a short 20-minute period. Not my pig, not my farm. I don't give a if they are hedged properly. There's no rule, there's no law. Like, if you can't hedge appropriately, not my problem. If I want to YOLO into options with my money, I can. You think I'm gonna be crying a tear for the market makers who have such a tough time keeping their book neutral? No, they can lick my dude, it's not my problem. So anyway, that's apparently the problem of why the market is going down. It has apparently nothing to do with the overall global economy and the state of things getting worse. Apparently, it's just the retail degenerates who are ruining the fun for everyone.